picture this. You're sitting at your kitchen table, or maybe you're just glancing at your phone while waiting in line for coffee.
Right, we've all been there.
Yeah, and you open up that quarterly 401k statement. The market has been, incredibly volatile lately. The financial news is flashing red, and the headlines are just full of doom and gloom.
Oh, absolutely. It's inescapable.
It really is. So you look at your balance, you see that the value has dropped, and you feel that immediate, visceral spike of panic in your chest.
I mean, it's terrifying.
Exactly. Your hard-earned money, the capital you're relying on for your future, is just shrinking.
Yeah.
But what if the way you're defining safe to stop that bleeding is actually guaranteeing you'll lose money over the next 30 years?
That is the million-dollar question, isn't it?
It is. So today, we are tearing apart the myth of low-risk investing. We're doing a deep dive into the source material, safeguarding your future. Low-risk 401k investment strategies.
It's a great source. Lots to unpack.
Definitely. Our mission today is to extract the actual science behind minimizing risk while still maintaining the predictable growth you need for long-term stability.
Because the instinctual reaction to a red arrow on a statement is to, pull everything out of equities and just hide it under the floorboards.
Right, just stuff it in a mattress and pretend the market doesn't exist.
Exactly. But the ultimate goal of retirement investing isn't just shielding your capital from short-term market dips. It is about aligning your portfolio with your specific timeline so you don't inadvertently trade short-term volatility for long-term stagnation.
Wait, so you're saying safety can actually be dangerous?
Well, yeah, if you strip all the volatility out of a portfolio, you often strip all the growth out of it too. The objective is finding the structural mechanisms that let you sleep at night without sacrificing your future purchasing power.
Okay, that makes sense. So let's start with that floorboard mentality. Because if I move entirely to cash, I'm just losing to inflation, right?
Precisely. You're guaranteeing a loss of purchasing power.
So I need debt-based safety that mathematically outpaces the consumer price index. And the standout instrument for this in the source material is TIPS, or Treasury Inflation Protected Securities.
Oh, right, TIPS.
Now, a lot of people think of TIPS like a static savings account, but the mechanism is actually dynamic. I like to think of it, well, it's less like a mattress you stuff cash into and more like an escalator that speeds up when the stairs get steeper.
That's a really good analogy.
Thanks. Because with TIPS, the investor receives either the adjusted principal or the original principal, whichever is larger, meaning, you never receive less than what you originally invested.
Right, and the mechanics of that escalator are what make TIPS unique. I mean, if you buy a standard treasury bond, you receive a fixed interest rate on a fixed principal.
Okay.
So if inflation spikes to, say, 8%, the buying power of that fixed payout is just getting crushed.
Ouch. Yeah, that hurts.
But TPS are engineered to neutralize that specific dynamic. The principal value of the bond is directly tethered to the consumer price index. So as inflation rises, the government actually adjusts your principal upward.
Oh, wow. So the baseline itself moves up.
Exactly. And furthermore, your semi-annual interest payments are calculated based on that new, higher adjusted principal.
That's huge.
It is. You are structurally protected against the silent theft of inflation, which is why they form the bedrock of a conservative allocation.
But then we have money market funds, which are grouped in this same foundational safety category.
Right, another major player.
Yeah, and the source notes that money market funds invest in short-term government, prime, or municipal debt securities, and they maintain a stable value. So usually, a dollar in is a dollar out.
Correct. High liquidity, very low risk.
But here is my friction with this. If TPS are the escalator keeping pace with inflation, money market funds feel like standing still in the lobby.
That's fair.
Wait, if money market funds have such low returns, isn't there a risk that inflation silently eats away at my purchasing power over a 30-year career? Like, if I am sitting in an asset yielding 1 or 2% and inflation is running at 3 or 4%...
You are locking in a loss.
Right. I am safely losing my money.
You are hitting on the precise mathematical flaw of over-allocating to cash equivalents. I mean, if you park your entire retirement in a money market fund for 3 decades, you will absolutely outlive your money.
Wow. So why even have them in a 401k?
Well, the reason they exist isn't to generate absolute returns. It is to eliminate duration risk.
Duration risk.
Yeah. So when interest rates spike, a bond mutual fund holding, 10-year, 20-year debt will see its net asset value drop. That's duration risk.
Okay, because the old bonds aren't as attractive as the new ones with higher rates.
Exactly. But money market funds hold paper that matures in a matter of days or weeks. Because the duration is nearly zero, the fund can maintain that $1 stable value regardless of what the Federal Reserve does.
Ah, got it. So they serve as a shock absorber. They are the dry powder.
Precisely. They are the portion of your portfolio engineered for absolute psychological and capital stability in the near term. I mean, if the S&P 500 drops 20% in a week, the money market allocation hasn't moved a single cent.
Right. But the trade-off is that you are paying for that absolute lack of duration risk and lack of market risk by forfeiting yield.
You give up the growth to get the safety.
Which means if I want my money to actually grow, I have to step out of the lobby.
Mm-hmm.
I mean, dry powder is fine for cash I need tomorrow, but I can't park a 30-year nest egg in something yielding 2%.
No, definitely not.
So I need better returns, but maybe I'm not ready to absorb a massive haircut in the broader equities market. What sits in the middle?
This is where stable value funds enter the picture.
Right, stable value funds. The source explains they offer higher yields than standard money market funds while remaining inherently conservative. And they do this using insured bond portfolios. I was reading this and it's like hiring a massive, intimidating bouncer for your retirement account.
Bouncer, I love that.
Yeah. The insurance policy literally stands at the door and keeps market volatility out.
That's a great way to visualize it, because the mechanism powering that bouncer is called a wrap contract.
Wrap contract. Okay, how does that work?
So a stable value fund takes your capital and buys a portfolio of intermediate-term bonds. Now, these bonds naturally offer a higher yield than the ultra-short-term paper found in a money market fund.
Because you're locking the money up for a bit longer.
Right. But intermediate bonds have duration risk. Their market value fluctuates daily as interest rates change.
Which we just established is exactly what we're trying to avoid if we want stability.
Exactly. So to eliminate that daily volatility for the investor, the fund pays a premium to an insurance company or a bank. This entity wraps the bonds in a guarantee.
So the insurance company is the one absorbing the actual market fluctuation.
On paper, yes. If interest rates rise and the underlying bonds lose market value, meaning they're worth, maybe 95 cents on the dollar in the open market, the wrap contract allows you, the investor, to still transact at the book value of 100 cents on the dollar.
Oh, that's wild. So I don't feel the dip at all.
You don't. The insurance wrapper amortizes those underlying market gains and losses over time, which smooths out the yield curve. You are guaranteed your interest payments and your principal, regardless of the broader economy.
You just see a steady, predictable line ticking upward.
Exactly.
Okay, but we need to contrast that guaranteed safety with index funds. Because an index fund or an ETF tracking the S&P 500 or the FT Wilshire 5000 offers diversified safety rather than guaranteed safety.
That is a crucial distinction. Very different types of safety.
Right. They're passive. They don't employ teams of analysts trying to beat the market. They just buy a tiny sliver of every company in the index. The risk is decreased through broad market exposure to maximize long-term returns. But, and this is a big but, you are naked to market fluctuations.
Yeah, there is no bouncer here.
No bouncer at all.
With index funds, you are relying on statistical probability rather than an insurance contract. I mean, if you buy a single company's stock and it goes bankrupt, your investment goes to zero.
Right, which is terrifying.
But if you buy an S&P 500 index fund and one company fails, the other 499 companies are still operating, innovating, and generating revenue. Diversification removes the idiosyncratic risk of picking the wrong individual stock.
Okay, so I won't lose everything if one CEO makes a terrible decision.
Exactly. However, you are completely tethered to macroeconomic reality. If the global economy contracts, your index fund will lose value.
So it requires accepting volatility in exchange for capturing the long-term upward trajectory of the broader market.
You have to stomach the drops to get the gains over 30 years.
Okay, so manually adjusting the ratio of all these vehicles, sliding capital between money markets to manage duration risk, stable value funds for wrapped yield, and index funds for diversified growth, that sounds like it requires constant vigilance.
It's a lot of work.
Yeah, most listeners don't want to be amateur portfolio managers on their weekends. They want an automated approach, which leads directly to target date funds, or TDFs.
Yes, the life cycle funds.
Right. And these automatically recalibrate your risk based on your chosen retirement date. They take an aggressive approach with heavy equity exposure when you are young, and then automatically glide down to a conservative approach, heavily weighted in bonds and stable value as you near retirement.
It sounds perfect in theory.
It does. But there is a massive distinction in the fine print here between a to-retirement fund and a through-retirement fund.
Oh, this is arguably the most critical mechanical detail an investor needs to verify.
Really. The most critical.
Absolutely, because a two fund reaches its most conservative asset allocation exactly at the retirement date, and then the glide path just stops. It freezes.
It just parks the car and turns off the engine.
Yes, whereas a through fund continues to adjust and reaches its most conservative point years or even decades after the retirement date.
Okay, let's run the math on a worst-case scenario with a two fund. Say I blindly clicked a box for a target date of the year 2000, because that's when I turned 65.
Okay, let's play this out.
So the fund hits its maximum conservatism right on schedule in the year 2000. It shifts to, say, 70% cash and bonds and only 30% stocks.
Well, initially you'd feel like a genius. I mean, the dot-com bubble bursts in 2000, equities get crushed, but you avoid the worst of it because your two fund parked you in safe assets. You preserved your capital.
Awesome, I'm brilliant.
But then you have to live through the next 2 decades.
Right, so about 2008, I am 73 years old. I am still locked in that exact same ultra-conservative allocation because the fund stopped adjusting. Then the 2008 financial crisis hits.
And the Federal Reserve drops interest rates to near zero for the next decade.
Which means my massive bond and money market allocation is suddenly yielding almost nothing.
Exactly. You aren't generating any meaningful income from the interest. You are just slowly eating your principal to survive.
Oh, man. And then we hit 2022. I am 87 years old. Inflation spikes to 8%. Because my asset allocation was frozen 22 years ago without a sufficient growth engine to outpace inflation, my purchasing power is suddenly decimated.
Yep.
So wait, if I accidentally pick a two fund but end up living 30 years past my retirement date,
Yeah.
isn't there a danger that my money just sits there completely stagnating?
Yeah.
I avoided the stock market crash in 2000, but I still outlived my money.
Yes. And that scenario perfectly illustrates why the set it and forget it mentality surrounding automated funds is so dangerous.
It's illusion.
Total illusion. A through fund assumes you will be alive for 30 years after you stop working, and that you will need a growth engine running for that entire duration. It might hit your 65th birthday at a 50-50 split of equities to debt, and then slowly glide down to its most conservative point when you turn 80.
So it keeps working while you're retired.
Exactly. Because income is never guaranteed, and TDFs are not risk-free. You have to look under the hood and understand the specific glide path you are strapped into.
Which brings us to the actual execution. The strategy of risk management through timing and rebalancing.
Right, the mechanics of how you actually drive the car.
Exactly. Because even if you have a target date fund, or especially if you're utilizing the 8 to 12 standalone options typically offered in a 401k plan, you have to actively manage your exposure.
Your risk tolerance is not static.
No, it fluctuates. The source mentions that choosing safer investments earlier in your career is perfectly valid if you are naturally risk-averse. But the mechanics of maintaining your chosen risk level require rebalancing. I think of this less like adjusting an audio mixing board and more like pruning a garden.
Oh, the garden analogy captures the actual underlying mathematics of the process perfectly. I mean, you don't just plant the seeds once and walk away.
Right, because if I plant a garden with 50% tomatoes, which are my aggressive index funds, and 40% carrots, my steady, stable value bonds.
Okay, I follow.
Say that tomatoes had an incredible season. They grow wildly. Suddenly my garden is 80% tomatoes. It feels like a massive success, right?
Yeah. Sure, you've got tons of tomatoes.
But my portfolio is entirely overgrown and off balance. My exposure to a sudden frost or a market crash is dangerously high. I have to prune the tomatoes back and use that space to plant more carrots just to get back to my 60-40 target.
And that pruning process is psychologically agonizing for most investors.
Oh, I bet. It feels wrong to cut back the thing that's doing so well.
Exactly. Human nature dictates that we want to hold on to the asset that is skyrocketing and abandon the asset that is moving slowly. But the mathematical mechanism of rebalancing forces you to do the opposite.
It's a systematic, emotionless rule that forces you to sell high and buy low.
Yes. When you trim your equity index funds from 80% back down to 60%, you are locking in the gains from a bull market. You take those profits and buy your stable value or TIPS allocation while they are relatively cheaper. It forces discipline onto an inherently emotional process.
So the actionable step here for you listening is to verify your plan's mechanics. Check with your employer's HR department or log into your portal to find out how often you are allowed to make investment changes.
And check whether your plan offers automatic rebalancing.
Right, because you can often set a rule to prune that garden quarterly or annually without having to manually execute the trades.
And automating the rebalancing removes the temptation to try and time the market. You accept that fluctuations are the natural respiration of the global economy, and you use those fluctuations to systematically fortify your target allocation.
So let's synthesize everything we've extracted from the mechanics today. Achieving a low-risk 401k strategy really requires defining what you're actually trying to protect against.
That's the core of it.
If you need a bedrock of inflation protection, TIPS utilize an escalating principle tied to the CPI. If you need absolute liquidity and zero duration risk, money markets hold ultra-short paper, but they will drag on your long-term purchasing power. Stable value funds provide higher yield by using wrap contracts to mathematically isolate you from bond market volatility. Index funds offer diversified growth by owning the entire market, accepting macroeconomic volatility in exchange for compound returns.
Yeah.
And if you rely on target date funds to manage all these ratios, you absolutely must verify the trajectory of your glide path. Are you in a to fund or a through fund?
It really is a comprehensive toolkit. But I want to introduce a variable here that fundamentally challenges the entire premise of how we structure these glide paths.
Okay, what is it?
Well, everything we have analyzed today, the transition from equities to stable value, the shift from growth to capital preservation, is anchored to a specific fixed retirement timeline.
By the day you turn 65, that's the golden rule.
But what if the chronological definition of retirement is obsolete?
Wait, obsolete, explain that, because the entire financial industry builds its models around that hard stop.
They do, and that model assumes your active income goes to absolute zero on your 65th birthday, which necessitates a hyper-conservative portfolio to protect the nest egg you are now solely relying on.
Right, because you have no other money coming in.
Exactly. But what if you transition to consulting part-time? What if you monetize a skill or sit on a board, keeping a steady stream of active income flowing in until you are 75?
Oh, I see where you're going with this.
If your cash flow doesn't drop to zero, your dependency on your 401k is drastically reduced. So how does that fundamentally rewrite your timeline?
Wow. It changes the entire definition of your financial risk. Because if I still have active revenue at 70,
Right.
I don't need to prune my equities back nearly as aggressively.
Exactly.
I can let that growth engine run much longer because I'm not forced to sell off assets to pay for my groceries.
Huh.
I should be indexing my risk tolerance to my actual cash flow, not just my biological age.
Precisely. The textbook assumes a cliff, but your reality might be a long, gentle slope. Your asset allocation has to reflect the reality of your human capital, not just an arbitrary date on a calendar. If you plan to keep generating value, your portfolio can afford to keep generating growth.
That is the exact kind of paradigm shift you need when evaluating your strategy. So the next time that quarterly statement lands in your inbox, bypass the panic. Open it up, look at the mechanics under the hood, and ensure your capital is actually engineered to support the specific reality you are building.
Well said.
Check your glide path, set up your rebalancing rules, and stay curious.
Thanks for joining us on this deep dive.